Good afternoon, everyone. So today's session, we are going to discuss about two financial services called factoring and forfeiting. And then we are also going to discuss about mutual funds. Okay. So let us first try to understand what is factoring. So factoring is a financial service that is provided by specialized financial institutions in order to help manufacturers and traders to manage their receivables. So what these manufacturers or traders do, in other words, factoring is actually a process of selling receivables to a third party on a discount. That means these manufacturers and traders, what they do is they sell their receivables to another third party at a lesser price, at a discount. So usually the supplier, who's also the exporter, assigns his accounts receivable in favor of the factor and gives notice of the assignment to the debtor, whoever is the person who has to receive the money, right? So this process of factoring has been extremely popular in developed countries. What the factors do is they undertake collection or accounting and management of debts of their clients. And the factor may either lend against accounts receivables or by purchasing invoices. And the factor will take responsibility of collecting the debt on behalf of this manufacturer or trader or whatever it is. So this factoring service, it might be offered with or without recourse. Factoring with recourse, it refers to the right of the factor to claim bad debts from his client. Whereas in without recourse factoring, the risk of bad debts will be borne by the factoring agent himself. So here the client will not come into picture even if there are any bad debts. In our country, factoring has not yet been fully developed, and about 80% of our trade transactions are on an open account system basis, right? So all units, particularly the small and the medium-sized units, they have to make considerable efforts to realize the sales proceeds without much success in creating financial difficulties for such units. So many a times what happens is these companies which fall under the small scale sector, they become sick, financially sick, only because of delay or non-realization of their dues from larger companies. So introduction of factoring service will therefore prove very beneficial for such units, as it will free these small and small sector units from the hassles of collecting receivables, and it also helps them, it enables them to concentrate on the product development and marketing, right? So the idea of introducing factoring services in India was first floated by Working Group on Money Market that was headed by Mr. N. Vagul. And this happened in the year 1987. So the Reserve Bank then constituted a study group in January 1998 for examining the introduction of factoring services. This study group was headed by Mr. C.S. Kalyanasunder, who was a former managing director of SBI. And this committee, headed by Mr. C.S. Kalyanasunder, it delivered its report in December 1989. And the recommendations of the Kalyanasunder committee were accepted by Reserve Bank of India. Later in the discussion, we will talk in detail about what were the recommendations of the Kalyanasunder committee. Let us now try to understand in detail the concept and types of factoring services. So, modern factoring involves a continuous arrangement under which a financing institution assumes the credit and collection functions for its clients, purchase its receivables as they receive or as they arise, we can say. It maintains a sales ledger. It attends to other bookkeeping activities related to such accounts receivable, and it also performs other auxiliary functions. So the various services rendered by factors for domestic sales are of 6 types: full factoring, recourse factoring, maturity factoring, advance factoring, undisclosed factoring, and invoice discounting. Okay, so the functions or ingredients of full factoring services are first one is financing by way of prepayment of the receivables. Second one is sales ledger maintenance. Third one is collection of receivables or recovery of bad debts. And the final one is credit protection against bad debts. See, when pre-financing is provided, but no credit protection is guaranteed by the factor, that means the client. It is called as recourse factoring. So what is happening here is the client will be required to refund the amount that is pre-financed together with the interest in the event of failure or insolvency of the debtor. Okay. However, when no pre-financing of the receivables is done, but the factor undertakes to pay the amount that is due only on the maturity of the credit period, it is called as maturity factoring. So, as far as international trade is concerned, a two-factor system is used. So what is this two-factor system? The export factor provides financing and other services as received by the exporter, and the import factor undertakes the credit assessment of the importers, establish credit lines on them wherever possible, and undertake control of receivable and take whatever steps are necessary to collect outstanding dues. Now, how does the pricing of the various services function? So the prices of various services by factors, it depends on various aspects such as creditworthiness of the customer, his track record, quality of portfolio, turnover, average size of invoices, etc. But the base level of this pricing depends on the various costs that are to be borne by the factoring organization. And the most important element that needs to be considered is the cost of funds. Okay. And the price for the financial services was suggested to be around 16% per annum. And the aggregate price for all services, it might not exceed 2.5 to 3% of the debt service. So coming to the organizational setup. See, banks have considerable experience in financing and collection of receivables, which should be associated with factoring services. So these services may be undertaken by banks by floating subsidiaries, and initially such organizations may also be floated on zonal basis. So let us try to understand the linkage between the banks and the factors. So it is envisaged that the suppliers will be able to obtain financial services both from banks as well as factoring organizations. It is therefore necessary to provide for proper linkages between banks and factors. So there should be arrangements where uh, uh, banks and factors furnish to each other information relating to parties which approach more than one agency. And it is also envisaged that there could be a three-party tie-up. What is this three-party tie-up? See, the debt being assigned to factors by suppliers and the former borrowing from banks. Alternatively, the supplier would borrow from banks and avail of debt protection, collection, and other the sale ledger management services that you usually get from a factor. So besides, there are also other areas in which banks and factors should collaborate for better working capital management, and in view of specialized knowledge, skills, and contacts of the factors. Factoring is especially useful and especially relevant for small-scale industrial units. These small-scale industrial units, they have been facing constraints in their operations on account of inadequacy of working capital. And this inadequacy of working capital is usually caused by delays in receiving payments for their suppliers. So a large number of small-scale units that are managed by the promoters or persons with technical orientation, they are not in a position to pay continuous attention to the aspects like debt collection, accounting, working capital management, and things like that. So by and large, these units do not have an organizational setup, or they do not have expertise in the area of credit management to attend to the all the follow up and recovery of dues from the buyers. Therefore, what these small scale units feel is they feel that factors with their systematic, specialized, and professional approach, they would be in a position to help them in debt collection. So the credit protection services of the factors would entitle these small scale units to be assured of payment on a fixed date, as also protection against customers' default. And as far as financing of receivables, uh, is concerned, while factors would provide another source of finance to SSI units, they cannot be expected to offer finance at concession rates, as is presently being done by banks to eligible units. So, for continuous availment of concessive finance, linkage between banks and factors is very much essential. And while the potential demand for factoring services from these small sector units is estimated to be sizable, it would really take some time in India before this demand could actually crystallize. And factoring for small scale units, it could prove to be mutually beneficial to both the factors and the small scale units. And factors should make every effort to orient their strategy to crystallize the potential demand from this sector. Coming to the legal framework, see, Indian law does not at present comprehensively deal with various aspects involved in factoring business. As such, it should be necessary to promote a special legislation in order to support the establishment and operations of efficient and viable factoring organizations. And to enable a factor to be in a position to collect the debt in its own right, it must take in assignment of book debts of clients. So the existing provision of Section 13 of the Transfer of Property Act, this provision is very inadequate to protect the interests of the factors. And to make factoring economically viable, it is essential that the assignment of book debts in favor of the factor is exempted from stamp duty. And various states should therefore be requested to remit the stamp duty. However, if complete remission of stamp duty is not acceptable, assignments up to specified amount or sales from specific sectors may be exempted from such duty. The Civil Procedure Code, it may be amended to clarify that the factored debts can be recovered by resort to summary procedure under Order 37 of the Code, in terms of which the defendant is not entitled as of right to defend the suit, which he can do so in ordinary suits. So let us now try to understand what are the guidelines of RBI as far as factoring services by banks is concerned. The banks with the prior approval of the Reserve Bank of India could form subsidiary companies for undertaking factoring services. The subsidiaries formed should primarily be engaged in this activity, and such other activities as are incidental thereto. Alternatively, banks may opt to undertake factoring services departmentally, for which prior approval of the RBI is not necessary. So the banks should, however, report to the RBI together with the names of the branches from where this activity is taken up. And the banks should also comply with the following prudential guidelines when they undertake factoring services departmentally. So what are those guidelines? See, as this factoring activity requires skilled personnel and adequate infrastructural facilities, it should not be undertaken by every branch the bank. It should only be undertaken by certain select branches of banks. And this factoring activity should be treated on par with loans and advances, and it should accordingly be given risk weight of 100% while calculating capital to risk asset ratio. And the facilities extended by way of factoring services, they should be covered within the exposure ceilings with regard to single borrower. That is, 15% of the bank's capital funds and 20% in case of infrastructure projects. This is as far as a single borrower is concerned. And for a group of borrowers, it should be 40% of the bank's capital funds and 50% in case of infrastructure projects. And the next guideline is banks should maintain a balanced portfolio of factoring services vis-a-vis the aggregate credit. So their exposure to such activity should not exceed 10% of their total loans and advances. And the next guideline is banks undertaking factoring services departmentally should carefully assess the client's working capital needs, taking into account the invoices purchased. And this factoring service should only be extended in respect of those invoices which represent genuine trade transactions. Banks should take particular care to ensure that by extending these factoring services, the client is not overfinanced, which could later result in misutilization of these funds or the client not repaying the money, or in other words, bad debts. Right? Now let us also look at the role of Export Credit Guarantee Corporation in factoring, ECGC, right? So what is this ECGC? Reserve Bank has approved the scheme evolved by the Export Credit Guarantee Corporation of India for providing a non-fund based export factoring services to all the exporters who are ECGC policy holders. So under the scheme, the ECGC will undertake non-fund based export factoring as an in-house service. It will grant by an endorsement to the policy 100% credit protection for bills that are drawn on approved overseas buyers. The ECGC will, however, confine only to export factoring and will not undertake domestic factoring. So it restricts itself to export factoring only. And the maturity factoring scheme as designed by ECGC has certain unique features, and it may not exactly fit into the conventional mode of maturity factoring. The changes devised, they are intended to give the clients benefits of full factoring services through a maturity factoring scheme, thus effectively addressing the needs of exporters to get pre-finance, that is advance, on the receivables for their working capital requirements. And one of the major deviations in this regard is a very important role and the special benefits envisaged for banks under the scheme. The ECGC will conclude a tripartite agreement with the exporter and his authorized dealer to the effect that in the non-payment of any factored bill, the ECGC would step in. It would unconditionally pay the authorized dealer the value of the bill immediately after the expiry of 30 days from the due date of the bill on the bank's advice of non-payment. So that is how ECGC steps in. And considering the above unconditional guarantee, the authorized dealer will discount the bills without recourse to the exporter, except except if the non-payment of the bill is due to the fault of the exporter, then the authorized dealer will still be paid by the ECGC as per the guarantee contained in the tripartite agreement, but the ECGC would have recourse to the exporter. So that is one extra clause that is available in this case, if the non-payment of the bill is due to the fault of the exporter. And then the exporter will authorize the authorized dealer to deduct the ECGC's factoring charges, which would be 1% to 1.5% from the proceeds of each bill and remitted to the ECGC. Vanita. In consideration of the above unconditional guarantee, the authorized dealer will then recourse to the exporter, except as indicated just now. Like I told you, like non-payment of the bill that is due to the fault of the exporter. Then the exporter will authorize the authorized dealer to deduct the ECGC's factoring charges, which should be around 1 to 1.5% from the proceeds of each bill and remit it to ECGC. And one more thing is the exporter will be associated with the efforts to recover the debt from the foreign buyer, and all necessary expenses will be borne by the ECGC. The expenses will be borne by ECGC, but the exporter also will take steps to recover the debt. Until such time the payment is made by the overseas buyer or the ECGC, the interest payment on post-shipment credit would be as per the Reserve Bank's directives, which are issued from time to time. And in the event of failure of the exporter to realize the export proceeds in the stipulated time, the ECGC will obtain direction from the Reserve Bank in their turnover, that is entitling them to recover the amount from the foreign party. This export credit guarantee scheme, the ECGC, it would also facilitate easier availability of bank finance to its factoring clients by rendering such advances so as to be an attractive proposition for banks, right? And this factoring agreement, it would be concluded by ECGC with its clients. It has an inbuilt provision incorporating an on-demand guarantee in favor of the bank without any payment or compliance or other requirements to be satisfied by the bank. And coming to the benefits to an exporter, what are the benefits of factoring system to the exporter? So the first benefit to an exporter is it has an option to give, the exporter has an option to give easier credit terms to the customers. That is, it has better protection than the letter of credit, right? The international letter of credit, without the need to insist on establishing a letter of credit. So that is the first benefit. And then another benefit is it can offer friendly delivery terms, like direct delivery to the customer without any risk. And another benefit to the exporter is reduced foreign bank handling charges. The foreign bank handling charges on documents are quite reduced. And there are substantial cost savings on monitoring and following up of receivables, overdue bank interest on delayed collection and recovery expenses that are related to bank debts. The exporter can save on all these things because all these aspects are now taken care of by the factor and not the firm, right? Then increase cost sales. Another benefit that the exporter has is export sales can be increased because the firm is able to offer more competitive terms to its customers, and there is better security than letters of credit. Then estimation of uncertainties relating to realization of accounts receivable that are resulting in better cash management to meet working capital requirements. And then there is complete freedom from monitoring and follow-up of receivables, and also these problems associated with bad debt recovery. And with complete freedom from chasing receivables, a firm can devote full attention to procurement. See, it need not focus on um, managing its receivables and things like that. It can pay full attention to procurement, production, marketing, and sales and growth of the business. Okay. Now let us talk about the problem of double financing of assets. And what are the uh, checks in place to avoid double financing of assets? So the RBI has directed banks to ensure that double financing of the same asset through factoring and bank finance does not take place. So in a factoring business, uh, a borrower sells his receivables to his factors in order to get immediate liquidity. And the factor buys receivables like bills from the borrower with an option of recourse or a non-recourse basis. And the cost of funds with the recourse option is higher by around 1% to 2% over the commercial bank's cash credit rates. And in a recourse option, the institution factoring a bill can go back to the company in case receivables do not come through. And the cost is much higher in transactions without a recourse option, as the risk element in the case of dishonor of bills now falls on the factor. And the RBI has also directed that banks and factors should share information about common borrowers to avoid a situation where a company might have taken working capital for an asset from a bank and also got it factored with a factoring institution. And the format in which such information is to be provided, that may be decided by the banks or the Indian Banks Association also. And the banks have also been directed to issue letters of disclaimers to the factor on book debts that are factored to facilitate assignment of debt. And a letter of disclaimer indicates the title of receivables. So the factors in turn should route the proceeds of prepayment and final adjustment through the borrower's bank. And in case of consortium banking, the proceeds will now be routed through the leader of the consortium. While in case of multiple banking, it is left to each bank to protect its interest. The regulatory authority to avoid double financing has clarified that the factors should insist on a no objection certificate from the borrower bank before extending financial assistance. And the norms for inventory and receivables have also been tightened. Banks have been asked to take a view based on the production and processing cycle. So borrowers should declare separately the extent of book debts that are proposed to be factored and those against which bank finance is to be obtained in their projection for assessment of bank credit. And banks, while arriving at the maximum permissible bank finance, they have been empowered to deduct from current assets the receivables proposed to be factored. And this would have been done before arriving at minimum requirement of net working capital and working capital gap. Alternatively, the amount to be received from factors is to be essentially considered as a source of fund while arriving at the cash gap or the cash surplus position. And apart from this, the borrower's bank now also has to obtain from the borrower periodical certificates regarding factored receivables in order to avoid the problem of double financing. And furthermore, it is now mandatory on factors to intimate the limits that are sanctioned to the borrower, to the concerned banks, and the details of debts factored to avoid double financing. So this could be cross-checked with the certificate obtained by banks from the borrowers. So factors and the banks, however, They need not exchange their assessment of credit rating of the borrowers amongst themselves. And the extent of finance obtained from factors need not come within the purview of the credit monitoring arrangement. Next, let us look at the factoring operations of SIDBI. SIDBI stands for Small Industries Development Bank of India. SIDBI introduced its own direct factoring services in 97-98 to help the small scale sector in timely recovery of their sales proceeds. So the factoring scheme of SIDBI, it is a comprehensive package of receivables management services, including the advance against invoices and other allied services such as collection of proceeds from the purchaser, administration of sales ledger, etc. This service aims to solve the small scale sector's problem of early recovery of their sale proceeds from big purchases, and it ensures them of adequate liquidity at all times. So some of the salient features of SIDBI's scheme for domestic factoring, let us discuss that. So the main purpose of SIDBI to provide factoring services is they are particularly targeting the manufacturers in the small scale industry sector, supplying their produce on credit terms to various purchasers in the domestic market with a view to assisting them in their receivable management, as also providing them with finance against the receivables factor. And these facilities are these facilities are extended to existing units in the small scale industry sector, which have a good track record of performance and also sound financial position, supplying supplying components, parts, accessories, sub assemblies, etc. on short term credit to well established purchaser units. So they should have been in operation for at least 3 years, and they should have earned profits, and preferably they are declared dividend, even that is preferable. And one more requirement is the sales of this unit should preferably be spread over at least a minimum of 5 customers, with maximum sales concentration in a single customer being less than 30%. And the maximum credit period should be 90 days. So all this is to enable or to make sure that, all the sales are not concentrated to just one buyer, so that, if there are just 1 or 2 buyers, if there is default that is happening from that buyer's end, then the loss that it could face would be immense. And one more aspect that SIDBI takes into consideration is that the factoring products will in no way overlap its present services. So thus, while the services under the existing bill discounting scheme of the bank covers the supplies made by SSI unit against the bills of exchange, factoring would cover open account sales as well. Okay. Now, next, let us discuss the recommendations of the Kalyana Sundaram committee. So, just now, some time back, I told you that there was a committee established under the chairmanship of Mr. Kalyana Sundaram, who was a former director of SBI. So, this committee was established to study about factoring services in India. So they came up with some resolutions which were later accepted by RBI. In fact, factoring services in India originated based on the proposal of the Kalyanasundram Committee. In 1991, the SBI Factors and Commercial Limited, SBI Facts it is called as, it was established. And it is the first factoring company in India. So RBI issued guidelines for factoring services based on the recommendations of this Kalyanasundram Committee. Some of the main recommendations of this committee or group are so the first recommendation was that there is sufficient scope for introduction of factoring services in India, which would be complementary to the services provided by the banks. And the committee also suggested that introduction of export factoring services would provide additional facility to the exporters. And the committee also felt that while quantification of the demand for factoring services has not been possible, it is assessed that it would grow sufficiently so as to make factoring business a commercially viable proposition within a period of next 2 or 3 years. And the committee also opined that on the export front, there would be a fairly good availment of various services that are offered by export factors. And with a view to obtaining a balanced dispersal of risks, factors would offer their services to all industries and all sectors of the economy. And the pricing of various services by factors was essentially depend upon the cost of funds. The factors should, they should attempt a mix from among the various sources of funds to keep the cost of funds as low as possible, in any case, not exceeding 13.5% per annum. And this would ensure that a reasonable spread is available. The RBI could also consider allowing factoring organizations to raise funds from the Discount and Finance House of India, as also from other approved financial institutions, against their usance of promissory notes covering receivables factored by them on the lines of the revised procedure under bills discounting scheme. And the price for factoring services, that would be around 16% per annum, and the aggregate price for all other services should not exceed 2.5 to 3% of the debt services. So in the beginning, only select promoter institutions or groups of individuals with good track record in financial services and competent management should be permitted to enter this new field. And the committee also felt that initially these factoring organizations should be promoted on a zonal basis, and once they are successful in their respective zones, then they might be permitted to operate at a larger scale. The committee also said that there are distinct advantages in the banks being associated with the handling of factoring businesses. And what was that advantage? See, the subsidiaries or associates of banks, they are ideally suited for undertaking this business. Initially, it would be desirable to have only 4 or 5 organizations, which could be promoted either individually by the leading banks or jointly by a few major banks having a large network of branches. And factoring activities could, it was in fact this committee which suggested that factoring activities could perhaps be taken up by SIDBI, that is the Small Industries Development Bank of India, preferably in association with 1 or 2 commercial banks. Now, the business community, awareness also was one point that was raised by this Kalyanasundram committee. So, the business community should first be educated through bank branches about the nature and scope of these services and the benefits accruing therefrom. So the factors could not extend their services efficiently, effectively, and economically without the support of computers as quick and dependable means of communication. And concurrent with the consideration of various aspects relating to commencement of factoring operations, the promoters, according to this committee, should initiate measures for organizing network of computers, dedicated lines, the branches, agents in different parts of the country for accounting, follow-up remittance, and other activities involved in factoring business. And the central government, along with RBI, should initiate appropriate measures immediately for setting up specialized agencies for credit investigations. Until such agencies become fully operative, factors may have to rely on such information about clients, customers, as could be collected through banks or other sources. And since the suppliers would be able to obtain financial services from both banks and factors, it is necessary to provide for proper linkage between banks and factoring organizations. The committee also felt that providing factoring services to small-scale industrial units that is mutually beneficial to both the factors as well as the SSI units. And the factors should make every effort to orient their strategy to crystallize the potential demand for this sector. Right? So the RBI regulates factoring services in India under the Factoring Regulation Act 2011, which requires NBFCs to register as NBFC factors and adhere to prudential norms, including the minimum net owned fund requirements and reporting obligations. Here's a more detailed breakdown of the RBI guidelines for factoring services in India. Coming to the coming to the requirement of these entities, whichever want to get into this factoring service, they have to register with the RBI as an NBFC factor or an NBFC investment and credit company once they obtain the certificate of registration. And every company seeking registration as an NBFC factor, they must have a minimum net owned fund of rupees 5 crores or as specified by the Reserve Bank from time to time. And then coming to see the particulars of assignment of receivables, especially those that are financed through a trade receivables discounting system, that must be filed with the central registry within 10 days. Coming to forfeiting, what is forfeiting? Forfeiting is a term that is often heard in the international trade and finance circuit, which it is a mechanism that enables security and liquidity to exporters. Okay, so let us try to understand what is forfeiting. Forfeiting is a financial transaction that involves the sale of companies' receivables to a forfeiter. This practice enables businesses, especially exporters, forfeiting is a financial transaction involving the sale of a company's receivables to a forfeiter. This practice enables businesses, especially exporters, to convert their credit sales into immediate cash, reducing risks associated with international trade, such as credit risk, currency fluctuations, and political instability. So let us try to understand this process of forfeiting. So forfeiting process is a very straightforward process, is a very simple process, but it involves several steps, and all these steps are very, very essential. So the first thing is there has to be an initial agreement between the exporter and the importer. So the process begins when an exporter and an importer agree on a sales contract. So here the payment terms are typically set deferred, meaning the importer will pay the exporter at a future date. Then the second thing is creating bills of exchange or promissory notes. If once the agreement has been made between the exporter and the importer, the exporter prepares the bill of exchange or a promissory note, whatever is the practice followed between those two parties. Now, these documents, they serve as a formal promise from the importer to pay the agreed amount on a specified future date. Next, coming to how does the exporter approach the forfeiting agency? See, the exporter approaches the forfeiting agency presenting the sales contract and the promissory note or the bill of exchange, whatever was drawn. This is a very important stage, as this step sets the stage for selling the receivables. So receivable selling actually happens here. The forfeiter now conducts a thorough assessment of the credit risk involved, considering the importer's credit worthiness, political risks of the importer's country, and the stability of the currency involved. So this assessment is essential for determining the discount rate. Based on the risk assessment, the forfeiter quotes a discount rate to the exporter. This rate reflects the cost of assuming the risk and providing immediate cash to the exporter. And if the exporter agrees to the terms and the discount rate, they sell the receivables to the forfeiter. And this agreement is legally binding and transfers all rights of the receivables to the forfeiter. The forfeiter then pays the exporter the present value of the receivables. And this present value is made after deducting the agreed upon discount. So the exporter benefits from immediate liquidity and is relieved from the risk of non-payment by the importer. And what happens on the maturity date? On the maturity date of the receivables, the forfeiter collects the full amount from the importer. This step is the final phase where the forfeiter, who's now holding the credit risk, ensures collection as per the original terms of the sales contract. Though most of the times this is the final phase, in some cases the forfeiter may choose to sell the receivables in a secondary market to other interested financial institutions. Now, this step is optional and it depends on the forfeiter's strategy and market conditions. So by following these steps, forfeiting provides a very secure and efficient way for exporters to manage the financial risks that are associated with international trade, ensuring that they can focus on their core business activities without worrying about collecting the receivables. So, forfeiting offers a number of benefits. Risk mitigation. Risk mitigation is one of the biggest benefits that forfeiting offers. See, what happens because of forfeiting is credit risk transfer takes place. So what is happening is credit risk is being transferred from the exporter to the forfeiter. This means that once the receivables are sold, the exporter is no longer responsible for the risk of non-payment by the importer. And forfeiting also protects the exporters from uncertainties like, political upheaval, economic instability, or regulatory changes in the importer's country. And since international trade often involves multiple currencies, forfeiting can also mitigate the risk of currency fluctuations also. So risk mitigation in all these aspects is one of the biggest advantage of forfeiting. Then forfeiting also improves the cash flow and liquidity. See, what it does is it converts deferred receivables into immediate cash. So this actually improves or enhances the exporter's liquidity immediately. And with immediate payment, the exporters can better manage their cash flow. They can plan for future investments and they can also handle operational expenses more efficiently. Another biggest advantage of forfeiting is it facilitates larger transactions. It enables larger transactions. And the reason is, since forfeiting covers large amounts, which are typically involved in international trade, it enables exporters to take on bigger deals and contracts. Because of this service, it is allowing exporters to take on bigger deals. And with the reduced risk and improved cash flow, exporters are more inclined to explore new markets and expand their international presence. Forfeiting also provides balance sheet benefits. See, since the receivables are sold off, in forfeiting, what are we doing? We are selling off the receivables. So the moment they are sold off, they're removing from the balance sheet, right? And as they remove from the balance sheet, they can improve the financial ratios and the overall financial health of the exporting companies. And since forfeiting is a sale of assets or receivables, and it is not a loan, it is not reflected in the liability side of the balance sheet, or in other words, it is not increasing the company's debt levels. Okay, and then forfeiting also enables administrative and efficiency gains. So, managing receivables, especially in international trade, it involves considering considerable administrative work. Forfeiting reduces or sometimes eliminates this entire burden. Now exporters don't have to bother or worry about all these things. And the next one is efficiency in trade processes. So forfeiting streamlines the trade processes by simplifying the financial arrangements and by reducing the paperwork and the bureaucracy involved. And one more biggest advantage associated with forfeiting is the flexibility and customization that it offers. These forfeiting agreements, they can be customized to suit the specific needs of the exporter, including the choice of currency, the amount, and also the various terms of the sale. And it can also accommodate various time frames, ranging from short to medium terms, thus providing flexibility to exporters. And one more thing uh, that needs to be understood is the non-recourse nature, non-recourse to the exporter. See, what is happening in forfeiting is the sale of receivables is always on a non-recourse basis, meaning that the exporter is not liable to repay if the importer defaults. And this offers a significant peace of mind and security to the exporter, right? And then the exporter can actually, that is a big benefit to the exporter. And one more thing that forfeiting does is forfeiting improves the credit worthiness or the credit standing of their organization. It ensures timely payment. It reduces debt levels. Uh, by doing all this, what is it doing is it is enhancing the credit worthiness of the exporting company. Now, by understanding all these benefits, exporters can make very informed decisions about utilizing forfeiting as a tool to enhance their financial stability, as a tool to expand their business, and as a tool to navigate the complexities of international trade with greater ease and confidence. Now, let us during our discussion on factoring and forfeiting, both these services might have sounded similar, right? But there are differences involved. So, though both factoring and forfeiting involve the sale of receivables, uh, there is there are differences in certain aspects. So, factoring usually involves domestic receivables, whereas forfeiting is primarily used for international trade receivables. And another point of difference is factoring is used for shorter maturities and smaller amounts, whereas forfeiting, on the other hand, deals with larger and medium term receivables. And one more difference is there are different types of factoring, recourse factoring, without recourse factoring, and all that. But forfeiting is always a non recourse transaction. It is always a non recourse transaction. That means uh, uh, even if the importer defaults, the exporter is never liable to repay. Right? So, therefore, we can say that forfeiting is a very powerful tool for businesses that are engaged in international trade. It not only ensures financial stability by providing immediate cash flow, but it also shields businesses from various risks that are associated with international transactions. And for companies that are looking to expand globally, um, forfeiting is a very, very uh, invaluable financial strategy. It allows them to expand globally, and it also manages their financial risks very effectively. So this is about factoring and forfeiting. Now let us the third topic that we are going to discuss in today's class is mutual fund. So what exactly is a mutual fund? So a mutual fund is basically a trust that raises money through sale of units. So a mutual fund is a company that pools money from many investors and invests that money in securities such as stocks, bonds, and short-term debt. So the combined holdings of the mutual funds are known as its portfolio. And investors, general public, they buy shares in these mutual funds. So from the investor's point of view, a mutual fund is a vehicle for investing in portfolio of stocks and bonds. And by investment in mutual funds, investors get exposure to different segments of markets. As mutual funds are run by professional fund managers, the investors also get access to professional management of their investments. Now, this helps in wealth building and generating income for the investors. Mutual funds, they invest in a wide range of products that are available both in the money market as well as in the capital market. And they are one of the key participants in the financial market. Now let us try to understand some of the salient features of mutual funds. So mutual funds, they are a popular choice among the investors because of the following features that they offer. So the first one is professional management. If an individual wants to buy share, he will have to do research on his own. But the biggest advantage or the biggest favorable feature of a mutual fund is professional management. The fund managers who are well qualified, well experienced, they do the research for all the investors and they select the securities. They monitor the performance of these securities. The individual investor is saved from all these responsibilities. And another salient feature of mutual funds is diversification. So mutual funds typically invest in a wide range of companies and industries. What this helps is, this helps to lower the risk that could take place even if one company fails. So individual investors might be able to invest in one, two, three, four, or maybe five companies, not beyond that. But uh, what happens if the number of companies are large? The individual investor will not be able to track. First thing, he will not be having funds to invest in so many companies. And second thing, he will not be able to monitor the performance of so many companies. So usually individual investors limit themselves to fewer companies. But the problem associated with this is if these 1, 2, or 3 companies fail, then the entire portfolio of this individual investor uh, would not perform well. Whereas mutual funds, because of their expertise, they invest in a wide range of companies. Therefore, the risk also lowers. And affordability is also an issue. Uh, See, most mutual funds, they set a relatively low amount for the initial investment and subsequent purchases. So people can buy, for most of the mutual fund houses in India, 500 rupees is the minimum amount that can be used to buy units in a mutual fund. Whereas, uh, if I want to buy one share of Infosys or one share of TCS, they are all more than 500. So unless and until I have like 1,000, 1,200, 1,500, or 2,000 rupees with me, I cannot even buy a single share of Infosys or TCS. And purchase of fractional unit of shares is not allowed. So what mutual funds are doing is they are making investments in stock markets to general public more affordable. And apart from affordability, liquidity is also a major advantage that mutual fund investors get. They can easily redeem their units. They're not called as shares, they're called as units. They can easily redeem their units at any time based on the present NAV. NAV is the net asset value. So let us look at the structure of the mutual fund. So the mutual fund is a three-tier one. So there are three distinct entities involved in the process. The sponsor who creates a mutual fund, trustees, and the asset management company which oversees the fund management. So the fund manager is responsible to invest the pool money in the financial market based on common financial goals. So those investments are expected to generate returns which are passed back to the investors as dividends or additional units. And the scheme information document, it details the objectives of the fund. This gives clarity to the investor as to where their money is being invested. And all mutual funds, they have to be classified under different categories like equity fund, debt fund, hybrid fund, and things like that. And only one scheme is permitted in each category apart from the exchange traded funds or index funds. There are something called as thematic or sectoral funds also, and then there is something called as fund of funds also. So let us look at the evolution of the Indian mutual fund industry. Indian mutual fund industry uh, started in 1960s when UTI, Unit Trust of India, was established by an act of the Parliament. Uh, then UTI functioned under the regulatory and administrative control of RBI. And this UTI launched its first scheme in 1964. It was called as Unit Scheme 1964 or US 64. And in 1987, the public sector mutual funds were set up by the different public sector banks like, LIC, GIC, all of them. And as the industry started growing, the government of India opened up this sector to even private players also. So, the first private sector mutual fund in India registered in 1993, and it was Kothari Pioneer, which was the first private sector mutual fund in India. This Kothari Pioneer now merged with Franklin Templeton Mutual Fund. So since then, lot of private players have entered into the Indian mutual fund industry. Right? Today, there are almost 50 asset management companies that are operating in India. Right? So, like I told you, when mutual fund industry began in India in 1963, it was another regulatory and administrative control of RBI. But almost after 30 years, and that is in 1993, mutual fund industry came under the purview of SEBI, Security Exchange Board of India, SEBI mutual fund regulations, right? So these regulations are updated from time to time, keeping in mind the dynamic financial conditions, right? Now let us look at the organization structure of mutual funds in India. So mutual funds in India, they have a three-tier system, right? They have a three-tier system. So at the helm of the affairs is the sponsor who acts very similar to the promoter of a company. And SEBI regulations provide that a fund sponsor may be any individual or entity who can set up a mutual fund. And in the second layer is the trust and the trustees who play a significant role in maintaining investors' trust in following the fund's growth. And as per the regulations, a mutual fund has to be constituted in a form of a public trust. This trust should be created by the sponsor who makes the initial contribution to the assets of the trust. And the sponsor appoints a trustee by executing a trust deed in favor of the trustee. And the trust deed prescribes the rights and duties of the trustees. And the contents of the trust deed must conform to the requirements of the third schedule of the mutual fund regulations. And at least two-thirds of the trustees are required to be independent persons and not associated with the sponsors. Trustees and these trustees, they have to monitor all the activities of the mutual fund. They are the ones who are responsible to ensure that all compliances as laid down by SEBI mutual funds have been adhered to. And in the third layer is the asset management company. And this asset management company is established as a corporate entity under the provisions of the Companies Act 2013. So the trustees are responsible for appointing an asset management company to manage the trust funds for the benefit of the investor. And for this purpose, trustees execute an investment management agreement with the AMC. Okay. This investment management agreement prescribes the rights and obligations of the AMC, including their fee also. So the AMC is required to have at least 50% independent directors on its board. And the contents of the investment management agreement, they have been prescribed in the fourth schedule of the mutual fund regulations. So this asset management company, AMC as it is called, it introduces various mutual fund schemes in the market. These schemes are designed as per the market needs and they cater to investor requirements. So the AMC appoints a fund manager who is responsible to drive the scheme as per the objectives laid out. So the AMC is responsible to comply with all SEBI mutual fund regulations. Okay. One second. Yeah. So how do mutual funds actually work? So what are those various processes that happen? So first one is pooling of funds. So the mutual funds aggregate capital from multiple investors in order to create a pooled investment fund. And each investor holds shares and the fund's total value is determined by the net asset value, which is calculated on the collective value of assets. And then coming to professional management. See, expert portfolio managers, they oversee the mutual funds, and they are the ones who make strategic investment decisions in order to meet the fund's objectives. So their goal is to optimize returns while prudently managing risk through careful asset allocation and selection. And then coming to diversification. So mutual funds invest in a diversified range of securities, including stocks, bonds, or sometimes a combination of both also. This diversification spreads the risk across various assets, thereby mitigating or reducing the impact of performance in any single investment. Uh, And the investors who are purchasing mutual fund units, they acquire ownership in proportion to their investment. So the quantity of units an investor possesses, it reflects their stake in the overall fund. And what is this NAV? NAV represents the NAV or the net asset value. It represents the per share market value of the mutual fund. And how is it calculated? It is calculated by dividing the total value of assets within the fund's portfolio by the number of outstanding shares. And the investors who buy or sell shares at the NAV price, uh, which it fluctuates based on market conditions. The next one is mutual funds provide liquidity. It enables investors to buy or sell shares on any business day at the closing NAV. So this flexibility, it allows for relatively easy entry or exit from the positions, enhancing the investment accessibility. So mutual funds generate returns through capital appreciation. They generate returns through interest income and also dividends from the underlying securities. So profits are distributed to the investors in form of cash or additional shares, which are often accompanied by periodic income distributions. And sometimes there are some schemes wherein the investor can opt for reinvestment of these dividends. So that whatever the dividend is earned, instead of taking the dividends, the same money may be used to purchase extra units of the mutual fund. So that is also one aspect about mutual fund. Now let us try to understand what are the different types of mutual fund. There are a number of mutual fund schemes that are available in the Indian market today. So an individual investor has a lot of choice, and the individual investor, depending on his um, investment goals or based on his risk preference, can choose the scheme that he or she wants. The first and the most popular uh, funds are called as equity funds. So these funds, they invest primarily in shares, stocks of companies, and the aim is for long-term capital appreciation. They can be categorized based on market capitalization. Like for example, if it is all large cap stocks, then it is called as a large cap fund. If it is a mid cap, if that fund has mostly invested in mid cap stocks, it can be called as a mid cap stock or a small cap fund. Or there are some funds which keep changing their investment pattern. Sometimes they invest in large cap, mid cap, and small cap. So such funds are known as flexi cap funds. Then there is something called as debt funds. So these debt funds, they invest in fixed income securities like government bonds, corporate bonds. Debt funds invest in fixed income securities like government bonds, corporate bonds, and other debt instruments. So they offer regular income and they are relatively lower in risk compared to the equity funds. But obviously, the return that they offer is also lesser. Then there is another category of funds which are known as hybrid funds or balanced funds. So these funds, they invest in a mix of equity and debt instruments in order to achieve a balance between growth and income. Coming to index funds aim to replicate the performance of a specific stock market index like the Nifty 50 or the Sensex. So they follow a very passive investment approach. Whichever funds, whichever stocks are there in Nifty 50 or Sensex, they just replicate the same funds with the same composition also. Sector funds, now coming to sector funds, these sector funds, they concentrate on specific sectors of the economy. Like, if some people feel that, technology sector will do very well in future, so they would only want to buy technology company shares only. So they can invest in this technology fund or healthcare fund or banking fund. They are slightly riskier than the other funds because of their concentrated focus. But if some people, if investors are sure about growth of a particular sector, then they can go ahead with it. Then coming to tax saving funds, so these equity linked saving schemes, they offer tax benefits under Section 80C of the Income Tax Act. Earlier it was there, now it is not there, they have removed it. So they are called as tax saving funds. So, and these tax saving funds have a lock-in period of 3 years. Then coming to liquid funds. So liquid funds, they invest their money in short-term money market instruments. They provide very high liquidity and safety for short-term parking of funds. So I have some money with me, but I need it after a very short period of time. So such kind of funds I can invest in liquid funds. There are something called as gilt funds also. So these gilt funds, they invest in government securities, which are considered to be the safest investments, right? So they're suitable for conservative investors. And gold funds. So gold funds, they invest in gold related instruments. They offer investors exposure to the price movement of gold without owning the physical gold, right? Then coming to thematic funds, there's something called as thematic funds also. Thematic funds are nothing but the sectoral funds, like they invest only in infrastructure companies and things like that. So these are some of the types of mutual funds in India. And coming to the modes of investing, there are two modes of investing in mutual funds. A lump sum amount can be invested in mutual fund. That is, you have 1 lakh rupees with you, you can invest the entire 1 lakh rupees today. You have 1,000, the entire 1,000 could be invested today. Or investors could also follow the SIP route, that is the systematic investment plan route. That is, every month they can invest a certain fixed amount of money into the mutual funds. So every month, a certain amount of money is deducted from their bank account on the day that is specified by the investor himself. So these mutual funds, they offer a lot of benefits. They lead to capital growth, income generation is possible, and risk reduction is possible through diversification. They offer liquidity. In fact, mutual funds is the best way of encouraging general public to enter into the stock market. So not everybody would directly want to buy shares and monitor their performance. So, but still would want to benefit from the advantages that stock markets provide. For such people, mutual funds offer a very good option. So that is about mutual funds. So with this, we would end today's session. So tomorrow's session, which happens to be the last session, the three topics that we're going to discuss on: merchant banking, credit rating, and depository services. So with that, I would like to end this class and continue tomorrow's class. Thank you.